This week's economic data highlights a potential shift in the Federal Reserve's monetary policy, with a September rate cut becoming increasingly likely. The Consumer Price Index, CPI, for July showed a modest increase of 0.2%, bringing the annual inflation rate to 2.7%, slightly below the expected 2.8%. This marks the sixth consecutive month where CPI has underperformed economists' forecasts, driven by falling energy prices and stabilizing shelter costs. The core CPI, which excludes food and energy, rose by 0.3% for the month, indicating some persistent inflationary pressures in services like medical care and airfares. However, the overall cooling of headline inflation has led to a positive market reaction, as investors anticipate a more accommodative stance from the Fed. Conversely, the Producer Price Index, PPI, presented a more complex picture, with a surprising 0.9% increase against an expected 0.2%. This spike was largely attributed to extraordinary factors such as surging wholesale diesel prices and increased trade margins. When these volatile components are stripped away, the core inflation measure remains more contained, suggesting that the underlying inflationary pressures may not be as severe as the headline figure suggests. Meanwhile, U.S. retail sales rose by 0.5% in July, slightly below expectations, but still reflecting a resilient consumer sector, particularly in motor vehicles and home furnishings. However, a decline in spending at bars and restaurants indicates some consumer caution, likely due to ongoing tariff concerns. In summary, the mixed economic data underscores the challenges facing the Federal Reserve as it navigates its policy path. While the CPI suggests that inflation is moderating, the unexpected rise in PPI and cautious consumer behavior add layers of complexity. Nonetheless, the overall data landscape supports the growing consensus for a rate cut in September, as the Fed aims to sustain economic momentum amid global uncertainties and domestic inflationary dynamics.
The financial landscape is witnessing a significant shift as enterprises grapple with the true costs of deploying artificial intelligence (AI) at scale. While the sticker prices for AI models, such as OpenAI's GPT-4, have decreased significantly, the overall cost of AI implementation remains high due to hidden infrastructure, integration, and compliance expenses. According to PYMNTS intelligence data, 46.7% of businesses cite the cost of deployment as a major concern, second only to integration complexity. As highlighted by industry experts, for every dollar spent on AI models, businesses often spend an additional $5 to $10 to make these models production-ready and compliant with enterprise standards. The decision on whether to self-host AI solutions or rely on cloud-based services is crucial, potentially impacting up to 40% of AI-related expenses. While cloud solutions are ideal for prototypes, costs can escalate with increased workloads, as evidenced by a U.S. construction company whose cloud-hosted AI costs soared from under $200 to $10,000 monthly. Transitioning to self-hosting can significantly reduce these expenses, as demonstrated by a European retailer that successfully implemented a computer vision module for self-checkout machines at a fraction of the cloud cost. Despite the financial challenges, the long-term risk for businesses may lie in not adopting AI, as early adopters are already leveraging AI to improve processes, gain efficiencies, and enhance competitive advantage.
NUTX Health Inc., NUTX, has seen its shares plummet by 24% following the announcement of a delay in filing its quarterly report for the period ending June 30, 2025. This delay is attributed to an ongoing investigation by the law firm Hagens Berman into potential securities violations. The firm is urging investors who have incurred significant losses to come forward, while also encouraging those with pertinent information to assist in the investigation. The company's acknowledgement of potential significant changes in its financial results, as indicated in a response to an SEC inquiry, has further fueled investor unease. The exact nature of these anticipated accounting adjustments remains undisclosed, prompting speculation and heightened scrutiny from market participants. The controversy surrounding NUTX is closely linked to the implementation of the No Surprises Act, which has affected healthcare providers' revenue streams by reducing payments for out-of-network emergency services. NUTX has reported substantial declines in average payments from insurers, leading to the engagement of Halo MD, a third-party independent dispute resolution (IDR) vendor. However, a report by Blue Orca Capital has cast doubt on NUTX's financial practices, particularly its use of the IDR vendor and revenue recognition timing. Allegations against Halo MD, including fraud and racketeering, have intensified scrutiny on NUTX, with concerns that a majority of its recognized revenue may be incollectible. This has resulted in significant share price declines and ongoing legal scrutiny by Hagens Berman, which is investigating whether NUTX misled investors about its financial health and accounting practices.
The U.S. stock market concluded a strong week with minor declines as the S&P 500 slipped 0.3% from its record high and the Nasdaq Composite fell 0.4%, while the Dow Jones Industrial Average saw a modest increase of 0.1%. This performance marked the fourth winning week in the last 5 for Wall Street, driven by investor anticipation of a potential interest rate cut by the Federal Reserve in September. Such a cut could lower borrowing costs and stimulate economic activity, although concerns about inflation persist, underscored by disappointing wholesale inflation data that tempered expectations for aggressive rate cuts. Notably, United Health Group's stock surged 12% following Berkshire Hathaway's acquisition of nearly 5 million shares, reflecting Warren Buffett's strategy of purchasing undervalued stocks. In contrast, Applied Materials experienced a 14.1% decline despite strong quarterly results due to a cautious revenue forecast amid geopolitical and economic uncertainties, particularly concerning its China operations. SanDisk also saw a 4.6% drop as its profit forecast for the upcoming quarter fell short of Wall Street's expectations. The broader market dynamics were influenced by mixed economic reports, with consumer spending at retailers increasing as expected, but industrial production falling short of forecasts. Consumer sentiment also declined due to inflation concerns. In the bond market, Treasury yields rose slightly, reflecting ongoing uncertainty about future economic conditions and monetary policy. Internationally, China's economic slowdown, attributed to uncertainties from U.S. tariffs, contrasted with Japan's better-than-expected economic growth, affecting mixed performances in Asian and European markets.
FLY Group Inc., FLY, experienced a dramatic stock price collapse, plummeting approximately 87% on Friday, following allegations from the Bear Cave, a financial newsletter run by Edwin Dorsey. The newsletter accused FLY of engaging in a pump-and-dump scheme, a fraudulent practice where the price of a stock is artificially inflated to attract investors before insiders sell off their holdings at a profit, causing the stock to crash. This accusation, coupled with observed unusual trading patterns, particularly in after-hours trading, has raised significant concerns about the integrity of FLY's stock activities. The sharp decline in FLY's stock, from around $7.80 to 93 cents, resulted in a loss of over $100 million in market capitalization, sparking intense debate about the company's future viability. The Bear Caves report highlighted the involvement of overseas actors in manipulating the stock to trigger short liquidations and deter short sellers, emphasizing the need for investors to exercise caution. This incident underscores the broader risks associated with speculative trading and the potential for significant financial losses when involved with stocks suspected of being manipulated. This financial event not only affects FLY's stockholders, but also serves as a cautionary tale for investors about the dangers of speculative schemes in the stock market. The incident highlights the importance of due diligence and the potential impact of market manipulation on investor confidence and stock valuation. As regulatory bodies may scrutinize such activities more closely, this could lead to increased oversight and potential changes in market regulations to protect investors from similar occurrences in the future.
Michael Saylor, chairman of Strategy Inc., is making waves in the financial world with an ambitious plan to leverage Bitcoin through the issuance of perpetual preferred stock. This innovative financing instrument, branded as Stretch, is neither debt nor common equity, and offers dividends with a variable rate while providing no voting rights. Saylor's strategy aims to move away from traditional financing methods like common stock sales and convertible bonds, which have previously helped the company amass a $75 billion Bitcoin reserve. The perpetual preferred stock allows for flexibility in dividend payments and never matures, appealing to Saylor's goal of maintaining Bitcoin purchases without diluting shareholder value. However, the risk lies in the potential burden of high dividend payouts if Bitcoin's price declines, as the asset itself generates no income. The success of this financing model hinges on sustained investor interest and Bitcoin's market value. With $6 billion raised through 4 perpetual preferred offerings this year, including a $2.5 billion tranche that stands as one of the largest crypto capital raises of 2023, Saylor's approach has captured significant retail investment, yet the company's unrated status and the junior position of these preferreds in the capital structure make them less appealing to traditional fixed-income investors. If retail interest wanes, Saylor must attract institutional investors like insurers and pensions to achieve his ambitious fundraising goals. The strategy's viability is further challenged by the need to maintain liquidity in a volatile Bitcoin market, where the potential for a downturn could leave the company struggling to meet its financial obligations. Despite these risks, Saylor's bold move could push Bitcoin closer to mainstream financial acceptance, though it remains a high-stakes gamble dependent on market confidence and the cryptocurrency's stability.
Hild Asset Management has highlighted the significant impact of the ongoing temporary tariff suspension between the U.S. and China on various financial markets, as this truce approaches its conclusion on November 10, 2025. This pause in tariffs has provided a strategic window for investors, particularly affecting sectors like consumer electronics and industrial commodities. The suspension has bolstered Asian equity markets, with Japanese indices reaching new highs and U.S. technology and consumer stocks experiencing gains due to improved investor sentiment. ELD's Senior Vice President, Jason Harrison, noted that companies with strong pricing power and diversified supply chains are well positioned to capitalize on the current environment, although trade risks remain a concern. The tariff suspension has also had a notable effect on U.S. retail and logistics sectors, aligning with peak holiday import demand and allowing retailers to secure inventory under favorable tariff conditions. Freight operators have observed steadier booking patterns, and industry forecasts predict a modest global trade contraction of 0.65% for 2025. However, Chinese exports to the U.S. might see a significant decline if negotiations do not yield a resolution. In energy markets, crude oil prices are more influenced by seasonal demand and inventory levels than trade policies, with Brent crude and West Texas Intermediate trading near $68.77 and $65.71 per barrel, respectively. The U.S. Energy Information Administration projects record crude output for the year, while OPEC anticipates demand growth in 2026. Bond markets are pricing in a potential Federal Reserve rate cut, with 10-year U.S. Treasury yields declining and credit spreads narrowing, prompting L to favor selective duration extension and maintain liquidity reserves as a precaution against unresolved trade disputes.
Lineage Inc. is facing a class action lawsuit initiated by the Gross law firm, which alleges that the company misled investors during its initial public offering, IPO, on July 26, 2024. The lawsuit claims that Lineage provided false or misleading statements regarding its financial health, particularly concerning customer demand and pricing strategies. The company reportedly experienced a decline in customer demand due to increased cold storage supply and changes in consumer inventory strategies post-COVID-19, which contradicted the optimistic projections made during the IPO. This situation has allegedly led to stagnation or a decline in revenue, occupancy rates, and rent prices, contrary to the stable growth depicted in their registration statement. The lawsuit invites shareholders who purchased Lineage stock during the specified period to consider becoming lead plaintiffs, although this is not a requirement for participating in any potential recovery. The deadline for registration is September 30, 2025. The outcome of this lawsuit could have significant implications for Lineage, potentially affecting its stock price and market perception. This case underscores the critical importance of transparency and accuracy in corporate disclosures, as misleading statements can lead to significant legal and financial repercussions for companies. Investors and market analysts will be closely monitoring the developments of this case, which may also influence regulatory scrutiny on IPO disclosures.
OpenAI's release of ChatGPT-5 marks a pivotal moment in the AI landscape, with implications that could significantly alter the competitive dynamics within the industry. Unlike previous iterations, ChatGPT-5 is more advanced and capable of performing complex, multi-step tasks independently, a characteristic known as being agentic. This development is expected to centralize benefits among major AI infrastructure and niche platforms, leaving smaller horizontal software as a service (SaaS) providers potentially disadvantaged. As foundation models like ChatGPT-5 take over functionalities traditionally handled by entry-level software, the market is likely to see a consolidation of value among a few dominant players with strong competitive moats. The broader market context reflects this shift, as seen in the Russell 3000 index, where despite reaching new highs, fewer than half of its constituents are trading above their 200-day moving averages. This indicates a narrowing market breadth with leadership concentrated in a select group of high-momentum, high-conviction stocks. Key sectors poised to benefit from AI's evolution include AI infrastructure, vertical software with defensible niches, and platforms rich in proprietary data. Meanwhile, SMB-focused software solutions face headwinds as their offerings become increasingly replicable by more advanced AI models. Investors are advised to focus on infrastructure and high-moat platforms, adopting a strategy of buying on market dips and avoiding overexposure to easily replaceable horizontal applications.
Mortgage rates have reached their lowest point since October, currently standing at 6.58% for a 30-year fixed mortgage, according to Freddie Mac. This decline has invigorated the housing market, with increased optimism about potential interest rate cuts by the Federal Reserve. Market participants are pricing in a 91% likelihood of a 25 basis point rate reduction in September, with an 88% probability of a subsequent cut in December. This shift in expectations is thawing the previously stagnant housing market, as lower rates encourage buyer activity and stimulate demand. The drop in mortgage rates has had a pronounced effect on homebuilder stocks, with the SPDR Homebuilders ETF XHB outperforming the Vanguard S&P 500 ETF VU by 9% in August. This marks a significant recovery from the XHB's previous underperformance, which saw it lag behind the broader market by nearly 30% since October 2024. Technical indicators suggest a potential breakout, with the index surpassing its 200-day moving average and nearing a key resistance level. Contributing to this momentum, Berkshire Hathaway, led by Warren Buffett, has increased its stake in Lennar Corp, signaling confidence in the sector's recovery.